Thank you for visiting this presentation on Pay As You Earn, a pretty comprehensive analysis of Pay As You Earn. I've done a previous video presentation discussing Pay As You Earn as well as IBR, but this is specific to just Pay As You Earn and is a little bit more comprehensive. And again, thank you for visiting. My name is Sergio Estavillo. I am the founder and CEO of Sigma Financial Solutions, which is a tax and accounting firm dedicated to health professions, more specifically the dental profession. There's my contact information. You can visit my Facebook page for more information on articles, things of that nature. Also, the YouTube video channel that I've created with other topics that I discuss as well. So you're welcome to view those videos as well as feel free to forward the link to any colleagues who are interested in this as well. I'm also what's called an enrolled agent. A little blurb about an enrolled agent. I'm licensed by the U.S. Department of the Treasury as a tax practitioner professional. Like attorneys and CPAs, enrolled agents have unlimited practice rights before the IRS. Just to give you a sense of the scope of an enrolled agent. I am also certified as an Intuit Pro Advisor for their QuickBooks products. If you're not familiar with QuickBooks, it's kind of probably the leading financial software that health professionals use in helping them create their financial accounting information. So I'm sure you're familiar with some of the practice management softwares such as EagleSoft, Open Dental, Dentrix. That's in reference to practice, patient practice management. The flip side to that is the financial portion, which a lot of dental offices or professionals use QuickBooks for that aspect. So let me go ahead and get started with this presentation. Pay As You Earn. So who qualifies for Pay As You Earn? So there you have those 4 bullet points. Typically, it's the first bullet point that either qualifies you or does not qualify you for Pay As You Earn. So essentially what it says is that you cannot have an outstanding balance on a direct or FELP loan as of October 1st, 2007. FELP stands for Federal Education Loan Program. So if you had either a direct or FELP loan that was issued on or before October 1st of 2007, then you probably do not qualify for Pay As You Earn. The second condition is if you did have a FELP loan that was issued on or before October 1st, but you paid it off prior to having any new loans issued on or after October 1st, then potentially you could qualify. The problem with that second criteria is that it was established after that October 1st, 2007 date. So you wouldn't know to anticipate that or prepare for that. So usually if you had a direct loan issued on or after, on or before October 1st of 2007, you didn't know to pay it off before getting new loans in order to qualify for Pay As You Earn. The third bullet point is that you had to receive a direct loan, or a direct loan disbursement on or after October 1st of 2011. And finally, your Pay As You Earn payments must be less than the 10-year standard monthly payment amount, so otherwise known as partial financial hardship. And that should be, in most cases, you should probably meet that condition. So for all practical purposes, it's that first bullet point, whether or not you qualify for Pay As You Earn. Did you have any loans issued on or before October 1st of 2007? If it's yes, then unfortunately you probably do not qualify. And then if it's no, then you probably do qualify for Pay As You Earn. What loans are eligible for Pay As You Earn? It's only direct loans. So at the bottom of that page I have a site where you can identify the types of loans that you have outstanding. So if you visit nslds.ed.gov, you should be able to identify what types of loans, federal loans, you have outstanding. If you do have FELP loans, there is a course of action that you can take to resolve this issue. So you would want to go to studentloans.gov in order to consolidate your loans. Once the consolidation does occur, they convert those loans to direct consolidation loans, and potentially you are eligible for pay-as-you-earn if you had, again, that first criteria I mentioned above. You cannot have any outstanding balance on a direct or FFELP loan as of October 1st of 2007. But if if you decide to pursue consolidation because you have FFELP loans, you would go to studentloans.gov and consolidate on that website. Now, some of the details of the program. So 10% of your adjusted gross income less a minimal living allowance is used to determine your annual payments under pay-as-you-earn. And the minimal living allowance is based on the number of family members as well as the state of residence. So that living allowance is a little bit higher for those individuals who reside in either Alaska or the state of Hawaii. Just kind of as a general rule of thumb, the effective rate is approximately 9% of AGI, assuming one in family, on an annual basis. So if I have a $100,000 income, then under pay-as-you-earn, I would expect to make annual payments totaling $9,000, or about $750, despite whatever my balance might be. So if I have $400,000 in student loans, and I qualify for pay-as-you-earn, and I have a modest income relative to my outstanding debt of $100,000, then I would expect to pay approximately $750 per month. It makes this, it makes your student loan payments much more reasonable. They also can extend your repayment period to up to 20 years, so you should just be aware of that. And the final bullet point, which could make a significant difference, but if you leave pay or no longer qualify, any capitalized interest is limited to no more than 10% of the original principal balance at the time that you enter pay. So a quick example, if I had $500,000 of outstanding principal balance, once I enter entered pay, if I don't qualify for pay, or I forget to reapply, or I opt out, then no more than 10% of the original principal balance, or $50,000 if I have $500,000 outstanding, will be capitalized to the principal balance at the point that I no longer qualify. And I'll go into a little bit more detail about that in just a second, but it does make a significant difference, that limitation of 10%. Compared to IBR, IBR doesn't have that 10% cap, so you could be responsible for the full amount of unpaid interest, capitalizing to the principal should you no longer qualify for IBR. But for pay-as-you-earn, there is that 10% limitation, and I'll go into detail about that in just a second. Some other benefits, if you're looking to purchase a home, it's going to lower your debt-to-income ratio substantially, and make you more competitive. So entering pay-as-you-earn will do that. It'll also increase your cash flow significantly. And if you're looking at a practice loan, one of the things they'll consider is your cash flow and your ability to meet all your obligations in order to secure a practice loan. So essentially, what a dental practice lender will look at is there sufficient cash being generated by the practice to meet the obligations, the financial obligations of the practice, which would include a salary to you. It would include the loan payment, the debt service of the loan, as well as your overhead rate. So your overhead rate would include, salary to staff, lab fees, dental supplies, the lease payment, as well as the practice loan. In addition to that, they're also looking at your personal expenses. Is the practice generating enough cash to meet all those obligations? And if you're able to lower your personal expenses via the pay-as-you-earn program, then it may be more likely that you're able to secure a practice loan. So that's one thing, one of the benefits that you should consider in reviewing and analyzing pay as you earn. The third bullet point essentially kind of captures those first two. It presents financial opportunities probably sooner than you otherwise would be able to in a more traditional student loan repayment option. So there, i.e., a practice, a practice purchase, home ownership, things of that nature. And the fourth bullet point, there is loan forgiveness after 20 years. So after 20 years or 240 payments, and the payments can include zero payments if you're designated to have zero payments, but could be included in that 240 payment requirement, the loan is forgiven. So any outstanding balance, including the interest and unpaid principal, it can be forgiven. As I mentioned, the capitalization rule, that no more than 10% of the original balance is capitalized if you no longer qualify for pay. And really there's three conditions that you would no longer qualify. One, you choose to opt out. At the point you choose to opt out, then potentially 10% of the unpaid interest can be capitalized. 10% of the original balance can be capitalized to your principal at that point. So you choose to opt out. You forget to submit your annual income verification. So with pay as you earn, you have to submit annual income verification in order for them to determine your payments. And say you forget to submit that, then unfortunately you could be disqualified for pay as you earn. And the third trigger point is that your income no longer qualifies you or identifies you as having a partial financial hardship. And with that third item, you would reach that point once your adjusted gross income equals or exceeds 150% of your original student loan balance once you entered pay. And that's an approximation. So say you had $400,000 in student loans once you entered pay. If your income equals or exceeds your adjusted gross income equals or exceeds $600,000, then you could be disqualified from pay, and as a result you're subject to that interest capitalization, but not to exceed more than 10% of your original capital balance. And I'll go over that information in just a second on the spreadsheet. Now the concerns, one of the concerns is negative amortization. And what negative amortization is that your payments are so low they're not enough to cover the interest due on the loan. And I'll give you some very specific examples about that in just a second. Second bullet point, there is loan forgiveness, but it's considered taxable. It's considered a taxable event. So once that loan is forgiven, at the point it's forgiven, you're going to get a 1099 cancellation of debt from the loan servicer, and then you have to report that canceled debt as income to you for that particular year. So just kind of a timetable here. You enter pay as you earn in July of 2014. You're 20 years into repayment. You might get a, say, 1099 cancellation of debt by the end of January of 2035, and then you have to report that income once you file your tax returns, which are due approximately, say, April 15th of 2035, and you have to determine the tax liability associated with that forgiveness amount and pay whatever taxes are determined as a result of that forgiveness. Then the other item is that you have to annually submit income verification in order to continue to participate in pay as you earn. So your loan servicer will contact you, anywhere from 90 days to 30 days in advance of when it's required, and it's required usually on your anniversary date of when you started pay as you earn. So they'll give you ample notification to submit that that information, but yes, you need to submit on an annual basis income verification in order for the lender or the servicer to determine your payments for the next pay-as-you-earn cycle. I would suggest that you look at this site at the bottom, which will go over in detail all the various federal student loan repayment options. Oops. Apologize. Let me try that again. Okay, so now let me go ahead and go into the spreadsheet analysis. So, and let me go over some of these fields to give you a better sense of what we're discussing. So here I'm assuming a principal balance at repayment of $500,000. Obviously this can change depending upon your specific situation. So if I change this to $300,000, then some of the fields will change. It'll automatically recalculate some information, but I'm just going to assume for now $500,000. And based on current interest rates, say you're a recent graduate, the last couple of years or something of that nature, you're looking at the interest rates of the Stafford, which have been at 6.8%, and then the Graduate Plus, which have been approximately 7.9%. So I'm using an average of 7.5%. Based on that interest rate and this outstanding principal amount, this would be your standard 10-year repayment amount. So again, in order to be identified as having a partial financial hardship, your pay-as-you-earn payments have to be less than the 10-year standard payment amount. So here we're estimating that the 10-year payment amount would be about $5,900 per month. They also take into consideration, as I mentioned, the number in family as well as the poverty income level. So this information is used to determine your pay-as-you-earn payment. So as the number of family members increases, this amount will increase as well, and that will result in a lower monthly payment as a result of having a higher number of family. So just to give you a quick example, say you have one in family, the poverty income level for this for 2014 is 11,670. That is subtracted from this AGI to arrive at this pay-as-you-earn payment. So let's say that you have 5 family members, and as a result, 5 family members, your new payment under pay-as-you-earn drops about $250. So let me go back here, do 1. So this is 520, and if you have 5, this drops down to 317. So it drops about $200 as a result per month, as a result of having 5 family members in family. So this will just give you kind of a sense of what information is taken into consideration to arrive at these amounts here. And I'll go over these fields in just 1 second. But let's keep in mind why you're considering pay-as-you-earn as your repayment choice. At $550,000, $500,000 outstanding, at 7.5%, your standard 10-year repayment amount would be about $5,900, and this is the default repayment option. So unless you tell your loan servicer otherwise, you'll enter repayment under a 10-year standard repayment amount. So let me go into an amortization schedule for a 10-year payment amount on $500,000. So at $500,000 at 7.5%, this would be your monthly payment. That payment consists of an interest payment of about $3,100 as well as a principal payment of about $2,800. So after one payment, this would be your new balance outstanding of about $497,000. But keep in mind, how many of you can afford to make a $6,000 per month payment? And if you're working in Southern California as a recent graduate and an associate of, say, of a corporate dental office, you might make, let's say, $100,000. In California, if you look at the federal income tax rate, the state income tax rate, as well as Social Security and Medicare, on $100,000 as a single filer, your probably your overall tax rate would be about 35%. So if you have $100,000 less, $35,000 in taxes nets you out about $65,000, and that translates to about $5,500 per month. And if your student loan payments on a 10-year schedule are $5,900, it just doesn't work out. The math does not work out. But let's carry through this calculation. So on a 10-year repayment term, over the life of this loan, you would have paid back a total of about $712,000, or about $212,000 in interest. But given that this probably is not manageable, let's look at a 25-year extended repayment option using a standard amortization schedule. So you can just call your loan servicer if you want to extend it to 25 years, and they should be able to do that over the phone. And as a result, on $500,000 at a 7.5% interest rate, your monthly payments drop to about $3,700 per month. Again, is that reasonable? If you have a $100,000 income living in California as a single filer, you're losing $35,000 to taxes, netting out $65,000 annually, or about $5,500 per month, and the first $3,700 is going to student loan payments. It only leaves you about $1,800 for everything else. So that's probably not manageable either. And over the course of 25 years, what is your total payments? So you have to take that in consideration when evaluating all these repayment options. So your total payment comes out to $1.1 million. So that would total out to about $600,000 in interest payments. So by extending that payment period by an additional 15 years from that 10-year mark, you're really increasing the cost of that loan. But again, the concern is probably whether or not you can afford that monthly payment under a 10-year term. There's a third option. You can consolidate your loans, and by consolidating your loans, you can consider a 30-year repayment option. And a 30-year repayment option with a $500,000 outstanding principal balance with 7.5%, your monthly payments drop to about $3,500. So not a significant drop from the 25-year repayment. I think the 25-year repayment was $3,700, so the additional 5 years only drops it by about $200 per month. But look at the overall cost of this loan. So your costs increased to about $1.258 million. So you pay an additional $758,000 of interest over the life of that loan. So obviously a significant investment. So let me go ahead and look at pay as you earn, because that's probably the most manageable and practical repayment option for a lot of students. So I've kind of discussed all these terms up here. So let's look at these columns. So the repayment periods, you want to look at the repayment periods here, and it just goes through 1 through 20. Your adjusted gross income is captured there. So adjusted gross income, or AGI, is a very specific tax term, so you should become familiar with it. So based on your AGI, as well as the number in family, it'll influence your monthly payments under pay as you earn. So I've kind of already demonstrated what happens is if the number in family increases, it'll affect your monthly payments by lowering those monthly payments. So say you have 6, so that monthly payments drop down to about $267, but I'm going to assume 1. Do you continue to be eligible for pay as you earn? So yes, yes, yes. Negative amortization. How much are you underpaying the interest from year to year? So this is a yearly amount, and this is the total unpaid interest to date. So this is a cumulative amount to that point. So after, say, in this example, after 4 years, you've underpaid the interest by a total of $116,000. How much have you paid towards the principal is this column. If you're not paying any, if you're not making sufficient payments to cover your interest, then you're not reducing your principal balance. Here is your potential outstanding balance. This is probably what's recorded in the loan servicer, and these would be your annualized payments under pay as you earn. But let's look at this. Your AGI for your first year might not be correct. For pay as you earn, they use a look back period to the prior tax year. So say you graduated in May or June of 2014, they'll look back at your 2013 income information. So I would imagine that if you did graduate in May or June of this year, your income for last year was 0. So if I put in 0 here, it'll recalculate. So your monthly payments would be 0. How much did you underpay the interest based on this outstanding principal and this interest rate? So you've underpaid the interest by about $37,500 because it's the first year. And, your total unpaid interest is $37,500. Your principal balance stays the same. So potentially you have $537,000 outstanding, and you've made no payments. So let me change this just to give you kind of a sense of what happens, and I'll change these two fields. So let's say you had $350,000 outstanding. So your unpaid interest is $36,000 as a result of a lower outstanding principal balance. Then let's assume that compared to a $500,000 principal balance, let's assume that you have a better interest rate for whatever reason. Let's say 6.75, and as a result, then the negative amortization is lower as well because of the lower interest rate. Let me go back to the original terms that I had set up here. So $500,000 at 7.5%. Give you a sense what's happening. So your second year, again, they use a look back period. If you graduated in June, maybe you didn't get your license until August, and you started practicing in late August or early September. So you only have 4 or 5 months of income. So let's say during that period from September through December, you only had $40,000 of income. As a result, your payments would drop down to about $190 per month. You remain eligible. You've underpaid the interest after your second year by $35,000. So at this point, you've underpaid the interest in total by about $73,000. You haven't touched the principal at all, so potentially you have outstanding $573,000. For that second year, your total pay-as-you-earn payments only come out to about $2,200 over the course of that year. So your second year, let's say for whatever reason you make $111,000 of AGI, your payments pop up to about $780, very reasonable. So you should be able to afford to do that. You still remain eligible. You've underpaid the interest by $28,000, so a total of $101,000 after 3 years. In this example, you haven't touched the principal, and your new principal and interest balance, potentially under the loan servicer's books, is about $601,000. Over the course of that year, you've made a total of $9,349 in pay-as-you-earn payments. So again, very reasonable. So the expectation is that with pay-as-you-earn, your payments are much more manageable. As I mentioned earlier, that there's 3 trigger points that could cause you to be disqualified from pay-as-you-earn. So, one is that you choose to opt out. 2 is that you forget to submit your annual income verification. As a result, you don't qualify. And the third is that your income no longer qualifies you to be in pay-as-you-earn. And I'll mention this because one of the benefits with pay-as-you-earn is that despite the fact that you've underpaid the interest by about $101,000, if you no longer qualify to be in pay-as-you-earn, then the amount of unpaid interest that can be capitalized to your outstanding balances is limited to 10% of your original balance. So despite underpaying the interest by $101,000, they will limit the interest capitalization to no more than 10%, or $50,000 in this example, because you no longer qualify. So that's a nice benefit. And obviously, the longer you're in pay-as-you-earn, the more that can be written off if you no longer qualify. So the expectation is that you probably won't opt out once you're in pay-as-you-earn. You hopefully won't forget to submit annual verification of income. So the third is probably the most likely or realistic reason that you no longer qualify. So the third trigger point is that your income is so high that your payments under pay-as-you-earn are now higher than the 10-year standard payment amount. So at what income level does that happen? So as a general rule of thumb, it's at about 150% of your original principal balance. So if I have an example of $500,000 out here, if I have an AGI of $750,000 at any point, then I might be disqualified from pay-as-you-earn. And let me just do an example here. So let's do $750,000 at year 13 of repayment. So as a result, the spreadsheet is telling me no, stop, no. It's just kind of my dry sense of humor that essentially telling you better watch out. With $750,000, one in family, my new pay-as-you-earn payments are about $6,100. So it exceeds that 10-year standard payment amount of $5,900. As a result of that, I become disqualified, and then I'm responsible for $50,000 added to my outstanding principal. I have a new balance of $550,000. I would then default into a 10-year repayment term to pay that balance off. So say you have a good accountant, he or she is aware of the terms of pay-as-you-earn and are aggressive in making certain that you're exhausting all your deductions for tax purposes, and say that you're able to have your income adjusted to your AGI adjusted down to $725,000. And as a result, you continue to qualify for pay-as-you-earn. So your pay-as-you-earn payments are at about $58.95, below the $59.35 of the 10-year standard payment amount. So you continue to participate in pay-as-you-earn. So let's just say that you have, again, $375,000. So at this income level, you would be disqualified because your pay-as-you-earn payments at $5,900 far exceeds your standard 10-year payment amount of about $4,451. So let's say that here your outstanding balance, or excuse me, your AGI is 525, which is at about 150% of that mark. So your monthly payments would be $42.29 under the pay-as-you-earn payment, which is lower than the 10-year standard payment amount. So you qualify to participate in continue in pay-as-you-earn. Just a couple of examples of how you potentially could be disqualified from pay-as-you-earn as a result of income concerns. So let me go back to this information. So you get a sense of what the payments are. So income starts at 0, and after 20 years, at the 20th year, assuming adjusted gross income of $350,000, even at an adjusted gross income of $350,000, your student loan payments are only about $2,800 per month, as compared to a 30-year repayment term, you're looking at about $3,500 per month. So it's still below that 30-year repayment by about $800 per month. You remain eligible during this 20th year, assuming this $350,000 income, or just gross income, AGI, you're underpaying the interest by $4,200 for that particular year. So over the life of this loan, assuming these income amounts, you've underpaid the interest by approximately $465,000. You've not touched any of the principal, so your outstanding balance at this point on the servicer's book is $965,000. So, as I mentioned earlier, at this point, what happens is if your loan servicer would forgive this balance. So $965,000 is forgiven, but it's a taxable event to you. And this is where the concern comes in, and this is where you have to develop a comprehensive strategy on dealing with this tax event. So $965,000 is forgiven, but it is considered taxable income to you. So here's where the challenge kind of is for most students. So if I look at, and I'll address in just a second, if I look at the annual payments that I've made with Pay As You Earn, assuming these income amounts, my total payments only amount to $284,000. So I started out with the original principal balance of $500,000, but I've only made $284,000 in payments. So I've underpaid this loan at this point by $216,000. That's quite a deal. But given that $965,000 is forgiven, I'm assuming that if you live in the state of California, if you take into consideration both the state and the state and federal income tax rates, I'm assuming here that 50% of that balance is taxable income. So what I did was just look at 50% times whatever's forgiven to arrive at that tax liability. So again, the preparation you would have to make is that on April 15th of 2035, that you would have to write a lump sum check for this tax liability associated with this forgiven amount, and that amount that you would have to write is for $483,000, and this is what causes borrowers a great deal of concern. How do I prepare for that? But even in this event, so you had total payments of $284, you have a tax liability of $482, so potentially your total payments would be the combination of these two amounts. So if that were the case, my total payments would be approximately $767,000. Very reasonable considering it's a 20-year repayment term. So $767 in total payments, assuming this tax liability. So let's look at the 10-year total payments of $712. So it's about $55,000 more under Pay As You Earn, but you have an additional 10 years to pay that loan off. And compared to a 25-year, you're paying $1.1 million. So you're paying about $350,000 and more over the course of 25 years as compared to a 20-year repayment term with paid. But this isn't even accurate because you're going to need to save for that event. And what I try to do is capture that information in these columns. So what you need to do once you're in pay is you need to start saving, more likely investing money in anticipation for this tax liability. So you have to save right from the get-go. So the expectation is that because your monthly payments are so modest, is that you're going to be able to establish an investment account right from the beginning once you enter pay. So what would you need to do in order to have sufficient funds to meet this tax liability after 20 years? So I'm going to make a couple assumptions here. And the first assumption relates to this annual rate of return. So the annual rate of return I'm initially going to use is 7%. And why 7%? The benchmark for a lot of returns is what's referred to as the Standard & Poor 500. The S&P 500 are the 500 largest traded companies in the United States. So the expectation is that you're going to invest in probably, mutual funds, index funds, and I'll get into another fund type which is called a targeted date fund. But these funds invest in stocks. So with the S&P 500, historically that the rate of return is a little bit less than 8%. So for now, I'm going to assume, say, a 7% annual rate of return. So based on that annual rate of return, how much would you want to save on a monthly basis to see if you have sufficient funds to cover this tax liability? So let's start off with, I'm just going to say $500, which is minimal, very reasonable, very doable, considering the fact that your payments under Pay As You Earn are very, very modest. So at $500 per month over the course of 20 years at a 7% return, the future value of this investment would be $260,000. Not bad, but obviously not sufficient to cover this balance. So if I made $500 per month over the course of 20 years, that's 240 months, then I would have invested approximately $120,000 over the course of that investment period. I apologize, I was going to try to get my calculator out. So let me just get out a calculator real quick to give you a sense. So $500 per month for 240 months. So I would have invested a total of $120,000 at a 7% return. My total investment comes out to $260,000. So really, my investment return is about $140,000. So let's up this to, say, $1,000 per month. Still very manageable. You can do this, given the fact that your payments are so modest under Pay As You Earn. So the course of 20 years, you have $521,000 of investment value at the end of 20 years, sufficient to cover this outstanding balance. So let me do this calculation again. If I'm investing $1,000 per month over the course of 20 years or 240 months, I invested really $240,000. I have $520,000 available to me. That means my investment return is about $280,000. So certainly something that you can accomplish. But this, requires the discipline to do this, to get into this retirement mindset right off the bat. Excuse me, the investment mindset right off the bat once you enter Pay As You Earn. So let me just change some of these variables. So let's say you're more conservative. You don't want so much equity exposure, stock exposure in your investments. So you might decide to go more heavily into the bonds, into money markets, or into CDEs, which are more conservative investments. And as a result of that approach, say you get a 3.5% annual rate of return. What's your investment value after 20 years? So after 20 years, it's only about $346,000. So not sufficient to cover this balance due. And if you look again at 240 months at $1,000 per month, you would have invested really a principal balance of $240,000. At the end of 20 years at a 3.5% return, annual rate of return, you have $346,000. So you have about $106,000 of investment gain over the course of that 20-year period. Say you're more fortunate, instead of getting a 7% return, you get a 9% return over the 20-year period. So you would have a total investment value of about $668,000, sufficient to cover the balance due for that taxable liability, and you might have a bit of a windfall, so you have still some money available to you. So really, I think this is probably the most practical approach to saving for this tax liability, is that you need to start investing money right off the bat, over the course of 20 years in order to have funds sufficient to cover this tax liability. So let me go to a 7% return. So if I'm investing, $1,000 per month over the course of 20 years, my true cost of this loan is the combination of how much I made in pay-as-you-earn payments over the life of this loan, given certain income assumptions. So with those assumptions, I made total payments here of $284. Then if I'm investing $1,000 per month over the course of 20 years or 240 months, I've invested $240,000, assuming I get a 7% return. But the true cost of my loan is the combination of what I invested plus what I paid over the life of that loan. So really it's 248 plus 1,000 times 240 monthly investments, or $240,000. So my total would be, cost of loan would be $524,000. So I had a original principal balance once I entered pay-as-you-earn at $500,000. I made total payments really of $524,000. I've only paid $24,000 over that original balance. So the effective interest rate on this loan is 0.48%. So 1/2 of 1 percentage point, or 48 basis points. Even though the interest rate, the stated interest rate, is 7.5%, given the fact that so much is forgiven and my payments are so low here in total, really the effective rate of this loan is 1/2 a point, probably the cheapest loan that you'll ever have. So that's a consideration to evaluate when you're looking at pursuing pay-as-you-earn. Another one of the questions that I get from my clients is, they're fairly new to investing. How do they go about doing this? And I would suggest a couple of things. Is obviously you have to do your research. These are just suggestions for your consideration. What I would suggest is a fairly new fund program that is called targeted date funds. They're typically used for retirement, but you can use them for other purposes, such as investment goals with a fairly long time horizon investment period. So in this case, your investment period is 20 years. So you want a targeted date fund with a 20-year investment horizon. And what targeted date funds are similar to mutual funds that invest based on your time horizon. So with the 20-year time horizon, the asset allocation associated with that investment period will initially be heavily weighted towards equities or stocks. So the breakdown might be 90% stocks, so you have exposure to the stock market, and the remaining 10% is in more conservative investments such as bonds, money markets, CDs. So potentially you could, from year to year, you can have some substantial fluctuations in the value of that fund. But the expectation is over the life of that fund, you're going to get a greater return than you would otherwise in a more conservative approach. So you're looking for, say, a targeted date fund in a non-retirement account. So if you open a retirement account, there's other criteria that you have to meet in order to withdraw the funds or redeem the fund without any penalties. So in a retirement account for this purpose, in order to redeem it without a 10% tax penalty, you would have to be 59 and a half or older. So you would want to invest it as either an investment account, a personal account, or maybe a brokerage account in a non-retirement fund. In terms of companies, what I would suggest, again, a suggestion, is probably look at Vanguard or Fidelity, two very prominent investment companies, well respected. They have quite a few options in terms of investment opportunities. They are considered low cost providers, so they're cheap, and they give you some good advice in terms of investing as well. So a couple things that I would want you to consider is maybe look at this article. So it's in CNN Money. This is the ULR. So take a look at this article. Even though it's in reference to retirement, you're looking at a 20-year investment period. So these target date funds can be used for this purpose. Again, you probably do not want a retirement account, but you want a brokerage account or an investment account or a personal account. So it'll go over a sense of what a target date fund is. You're able to diversify within one fund. Then as you approach the end of that investment period, the investments in that fund will become more and more conservative. So here's something you want to target date funds can be helpful for inexperienced investors. It's a good way to invest and not be overwhelmed by the various options that are available to you, and it'll give you a sense of diversification automatically, as well as again, in the initial investment period, you're looking at those investments in equities or the stock market. So from year to year, the fluctuations could be fairly great, but as you approach the end of that that investment period, those investments will be more and more conservative. So try to look at this article, take a look and read it. I will also go to Vanguard. The two companies what I would suggest that you consider suggestions again are Vanguard as well as Fidelity. So I've already gone to that page with regard to their target funds. So despite the fact that it has retirement, you can have this as a personal investment account and a non-retirement account. So read this information, less risk through broader diversification. It's a low-cost program, and initially with when you start off this investment in the initial years, it'll be more aggressive. You'll have exposure to the stock markets. Then as you approach the end of that investment period, it'll become more and more conservative. And what I've done here is based on when you anticipate retiring. Again, it's not retirement, but when you expect the funds, when you need the funds to be available. It's about 20 years. So I'm looking at a target retirement fund of 2035. So that's appropriate. Don't be concerned with this terminology of retirement. Call Vanguard or Fidelity. Tell them that it's not really a retirement fund, but you want to invest for a 20-year investment period, and they'll set up a brokerage or a personal investment account. Here, these tabs, I'll go over these tabs real quick. So it gives you a sense of what's happening here, and it tells you right here the holdings are approximately 85% of their assets in equity, and equities are stocks in variously and various publicly traded companies, both in the U.S. as well as internationally, and 15% are in bond. That's the initial ratio. But as you approach the end of that 20-year investment period, this ratio will probably be inverted. Maybe not completely inverted, but it'll be more weighted heavily in more conservative investments and less exposure to equities or stock markets. The investment returns over these specified periods. So year to date, as of 5/23, 3.3% for year to date. Last year it was a return of 16.4%. The 5-year period has been 18%. The 10-year about 7%. The life of this fund has been about 7.5%. So in my calculations, I'm using a 7% return, which is fairly accurate, and reflective of the return of this fund. Then the expenses associated are only 0.188 of 1%. So, if you have $10,000 invested on an annual basis, you're only going to be charged about $18. So it's not significant. So that's one of the reasons you want to consider a low-cost provider such as Fidelity and Vanguard. And again, the asset allocation as reflected in this pie chart, about 84% are invested in stocks initially and about 16% in bonds. So risky in terms of stocks, a little bit more conservative in terms of bonds, but that's the expectation that you would have when you initially start this investment program. As you get closer to the end of your 20-year investment period, this asset allocation would be much more conservative. So another quick tab that I'll look at, annual expense ratio, we kind of discussed that. So a minimum investment amount to open up for this particular account is $1,000. So here there's an account service fee, I think is $25. Let me see. So a non-retirement account would be $20 annually, but I think it's waived once you exceed $10,000. So it's still not significant in terms of overall fees. So if you have $10,000 invested, you would have that 0.0018 that you would pay, as well as the $20 once you exceed $10,000. Then that $20 fee is waived, but still not significant. And this will give you a sense of what they actually hold in that fund account. Again, just to give you a sense of how to approach this in terms of an investment perspective. So suggestions for your consideration. I think pay as you earn, this is probably the way to approach this, is that you want to make the minimum payments, have as much forgiven as possible, and as a result you're going to have a tax liability, but you need to plan for that event. So that's probably the approach that I would take. Again, I appreciate your time. My name is Sergio Estavillo. You're welcome to give me a call, drop me an email. Some articles, some additional information on my Facebook page, articles, things of that nature, YouTube videos. I deal with associates who are paid as independent contractors, what you should be aware of in terms of additional tax liabilities, and then considering incorporating as an associate. It may not be in your best interest to initially incorporate because your income may not justify the additional fees that are associated with incorporation to offset that additional payroll taxes. So there's a video that addresses that as well. Just take a look at that. Hopefully you find this helpful, and I appreciate your time and consideration. Thank you.